But what happens if the stock doesn't move? Well, if the stock doesn't move, slowly, day by day, this option that you purchased, if the stock does not move, would slowly erode in value. Why? Well, the reason is that you have the right as a call buyer to purchase the stock at the strike price that you purchased, in this case $27.50, at any time before the third Friday of May. As we get closer to the third Friday of May, the chances of that stock moving up beyond this strike price of $27.50, above the price of $27.50, becomes less and less certain. And because of that, the option has less value to it. So, I mean, if you take a look at an option like this over time, let's say that the stock doesn't really move. If over time, like a week from now, maybe this option will be selling for 20-cent bid, 35-cent ask. A week after that, it's 15 cents and 20 cents, or 25 cents. The week after that, maybe it's 5 cents and 10 cents. So eventually, the option that you purchased at 40 cents with great hope that the stock was going to move up is now only worth about 10 cents. You've lost 30 cents on the trade. Well, that's exactly what the person who sold it to you is hoping would happen. That in fact, that the stock did not go up in price. That you purchased this option that they know is going to expire and will eventually erode in value over time. And that's how they make their profit. Because they sold it to you at 40 cents, they can buy it back at 10 cents, making 30 on that trade. Well, what about the guy who purchased the put option? The option that gives him the right to sell the stock at $27.50, hoping that it would go down so that he could buy it back at $22.50. If he could buy it at $22.50 and sell it at $27.50, he's made a $5 profit.